So what would you do if the stock market was crashing? What have you done in the past? Today we will provide you with some practical ideas to help you answer these questions if you are in your 40s and 50s. First, do you have the right investment mix? Second, what investments do you own and why? Are you ready to buy on the dip? And do you understand your tolerance for risk? And is your focus on the long term? And should you get a second opinion? Hello, Dave here with Living Your Wealth, and welcome to Whiteboard in the Wilderness. I'm presenting 6 strategies over a 2-part video series. In today's video, I will be discussing the first 3 strategies: investment mix, know your investments, and buying on the dip. By the end of today's part 1, you'll have learned what is a stock market crash, how to know if you have proper investment mix, and what the heck is buying the dip. It seems destined to happen sooner or later. One minute the market is hitting record highs, and next thing we know, we're in the middle of a stock market downturn. While the coronavirus outbreak was a primary driver behind the last market turmoil, the stock market does not require a pandemic to enter into decline. Market downturns are normal and can happen from many numerous factors. Although history can tell us how long crashes, corrections, and bear markets have lasted, no one gets a calendar notice announcing the time, nature, and projected magnitude of future dips. The stock market will decline at some point. It has happened throughout history. There is just no way to know when. How Gen Xers need to be acutely aware of this information, as we are sometimes closer to retirement than we realize. What is a stock market crash? While there is no specific number that indicates a crash, here is a bit of context. If the S&P 500 drops 7% in a single day, trading may end up stopping for 15 minutes. Called a circuit breaker to prevent the market from going into free fall. While only happening a handful of times in the market's history, it marks an awful day on Wall Street. Understanding that a crash could occur in the future means you can potentially plan for it today. We have put together a 6-step overview for Gen Xers and what to do ahead of time, and while you are in the thick of it. So first, do you have the right investment mix? For Gen Xers, having an appropriate mix of investments is key to potentially reducing overall portfolio risk. Adding diversification within asset classes, which includes stocks, bonds, commodities such as gold, takes it one step further, helping to smooth the ride through a rocky market. Diversification helps you manage risk and unnecessary risk by spreading out your investments across the entire financial market. Diversification comes in many flavors. You can break them down even more if you wish, but today we will focus on the 4 main types of investment portfolios, which is stocks, bonds, commodities, and cash. So first, stocks, or another term for it is equities, allows investors to own a piece of a company. Stocks may offer the highest long-term gains, but are volatile, and especially in a cooling economy. Bonds, or another term is fixed income, pay interest to investors who lend money to a company or government. Bonds are income generators that may offer modest returns, but are usually weaker during an expanding economy. Generally, bonds have an inverse relationship with stocks. Commodities, or natural resources or precious metals, are generally a resource that must be mined or extracted, such as gold, rubber, or oil. There's also another type of commodity, which is called a soft commodity, grown, such as cattle, wheat, or coffee. A basic definition would be a market that involves buying, selling, or trading a raw product. And lastly, cash, or cash equivalent, is money in your savings account, pocket, or hidden under your mattress. In terms of risk and return, cash is low on both counts, and cash can buffer volatility or unexpected expenses, and acts as a safe harbor to invest during opportune times. Owning a variety of assets minimizes the chances of any one investment hurting your portfolio. That trade-off is that you never fully capture the incredible gains of a shooting star stock. The net effect of diversification is slow and steady performance and smoother returns, never moving up or down too quickly. So what investments do you own and why? As was outlined in section 1, there are various types and styles of investments that you may own. The world of investment offers a seemingly endless number of choices and opportunities. The best investments for you will depend on many factors such as your time frame, hunger for risk, and financial goals. Situations and preferences change with time, so it is good to reevaluate your strategy as your circumstances evolve with the help of a financial planner such as myself. By knowing what you own in terms of investments, you may assess whether or not you will achieve your goals in the future. If you have a portfolio full of certificates of deposit and money market funds growing at 1% per year or less, you may not be able to retire with adequate income. The hardest part is when you are in your 40s and 50s, you may feel like you need to make major overhauls to your portfolio. You may experience this need if you change your family situation, such as divorce, your children are graduating from college, and you downsize your house. These pivot points are a great time to look at what is inside your investment portfolio and potentially make some changes. Other significant times we see people look at major changes to their portfolio is when there is an extended recession or they may lose their job. Many times when you feel pressure from outside forces, we feel to make emotional decisions with our money, when we have all done it, it becomes hard to stay consistent and you end up losing ground. An emotional reaction to a temporary slump is not a good reason to make wholesale changes. These situations are when having a close friend or family member you trust to speak with is fantastic, and even better, an impartial third party such as a financial planner. So be ready to buy the dip. Market dips are when you have a temporary decline in investment or market. It is a good idea to be ready for the fall and willing to commit some cash to snap up assets whose prices have dropped. For Gen Xers, last year was an excellent example of when to do this, potentially. Look at what happened to airline and hotel stocks early last year. There was a general feeling that they would recover, and some stocks lost 80% or more of their value in just 1 month. One strategy to overcome the fear of bad timing is dollar cost averaging. Dollar cost averaging involves a continuous investment into securities regardless of the fluctuation in price levels of those securities. An investor should consider their ability to continue purchasing through fluctuating price levels. The investment into dollar cost averaging will smooth out your purchase price over time and puts your money to work when other investors are huddled on the sidelines or headed for the exits. So please check out our video on this topic. You will probably not catch a stock at its low, but that's okay. The point is to be opportunistic on investments you think have a good long-term potential. Also, keep a running wish list of investments you would like to own and work with your advisor if you really want something. Your advisor should be open-minded and willing to review your suggestions. So set aside some cash so you're ready when disaster strikes. Do not be surprised though if you freeze in place during a moment of opportunity. There's no greater truth. So go on, Gen Xers, be brave. So one of the main reasons we provide these videos for you, Gen X, is education and providing objective advice. We want to help you to know and understand that there are many focus areas for financial planning, at least on a fundamental level. When you plan for the unexpected, the emotional and financial stress often ends up being far less taxing than if you did nothing at all. It is impossible to avoid every unforeseen situation, but we have witnessed firsthand the power of a financial plan. Thank you again, and we hope you have a great day. We'd love to hear from you, so please subscribe to our channel and like us if you enjoyed the video. As always, at the close of every video, we give you a quote from my favorite TV show called The Office. And we want you to guess which character said the line, and there's even extra credit for naming the season and episode. So please email me at david@livingyourwealth.com with your answer. I got 6 numbers. One more, and I would have had a complete telephone number. Yep, you'll know the guy right away. Thanks very much.